Hi, this is James Robinson, and this is my stock pick of the week. My goal is that every week I'll pick a stock that I think is undervalued, that's a very solid company, and tell you a little bit about why I think it's that kind of stock, why I think it's attractive. I'll do that every week and build a little portfolio of the stocks that I pick. We'll track their performance, and hopefully over time we'll build a community of people who appreciate my stock picks and people I can talk about stocks with. So, my criteria for what makes a great stock is really simple. I look for great companies that have a durable competitive advantage. Everything that I do is based on the teachings of Warren Buffett and Ben Graham and Manesh Prabhu and sort of all the super investors of Graham and Doddsville. It all starts with the book Security Analysis, which was written by Ben Graham and David Dodd. What I don't do is look for the next great thing. I love Tesla. I'd like to buy a Tesla car, but I don't think it's a great stock. I'm sure there's a solar company or self-driving car company or super duper gadget company, all of which would be spectacular investments that would make me turn $10,000 into a billionaire. But I don't know how to find those stocks, and so I'm not trying. I'm looking for solid companies, everyday companies, that just kind of do the right things every day and create profits for their shareholders. Today's pick of the week is Apple Computers. Apple is a technology company. Mostly it's known for its hardware. The firm's major products include iPhones, iPads, Apple Watches, AirPods, HomePods, Apple TV, desktop and laptop computers. All of these are top sellers in the categories. In addition to that, and just as valuable, is the interrelationship of its products. iPad, iPhone, Apple Watch, etc. all work seamlessly with each other to create an ecosystem. That ecosystem is boosted through iOS, Mac operating system, iCloud, Apple Store, iTunes, Apple Pay, iBooks, and other non-hardware related software services which create additional revenue streams, adding value to the company. Effectively, once you have a few of their products, you're so looped into the system that you're almost bound to continue to buy their products. In addition to hardware and software, Apple operates 506 retail stores, half of which are in the United States. The balance is spread over 24 countries. It has been reported these stores have higher sales per square foot than any other retail operation in the world. Apple is based in Cupertino, California. It has 123,000 employees. Apple has been on again, off again, the largest company in the world. It's currently second or third. It varies literally depending on the price of the stock that day. What's interesting to note is that Apple has a number of products which all by themselves would make Apple a member of the S&P 500. For example, the sales of the Apple Watch or the AirPods alone would make Apple a Fortune 500 company. Its retail stores by itself would be a Fortune 500 company. The scale of Apple Computer is really, really hard for most people to fathom. Throughout this presentation, you're going to hear me talk over and over again about just how big Apple is. To put this in perspective, Apple's market cap is $890 billion. Now, again, market cap is the total value of all of the shares that are outstanding. The last company that I looked at was a company called Martin Transport, and that company is worth about $900 million. So to put that in perspective, Apple is 1,000 times as big as Martin Transport. Martin Transport has 3,500 employees, has 2,500 tractors, and ships stuff all over the country. And here's Apple 1,000 times as big as that. Apple's revenues are $261 billion. They have profits of $59 billion. Their PE ratio is 15.57. Their yield is 1.53. And they have debt of $114 billion. And the amazing thing is, you know how much I hate debt, and I'm willing to advise you to consider buying a stock with $114 billion in debt. And you're going to see that in the scheme of things, that debt is virtually irrelevant relative to this company. It's hard to believe that much debt could be irrelevant. But that gives you a sense of how big, how successful, how well financed Apple is that I'd say that. So here you can see my heat map, which is really looking at the value of the company and how they do things. Again, I rate companies on a scale of 1 to 4, 4 being the highest. I rate them in 29 categories, 9 of which are operating functions, 10 of which are financial functions, and the balance of 10 are management functions. Management really looks at how well a job the company does of returning money to the shareholders. The financial looks at how well the company handles debt and risk, and operating looks at how good they are at delivering products to their customers. You can see that Apple has a grade of 3.22, which is amongst the highest. A total GPA of 3.28, which is amongst the highest of the companies that I looked at. We look for the spot spots for the company we don't like. R&D, we'll talk about that at length. Interest expense, we're going to talk about that at length, which even though I put it down as a 1 is really probably a 4. We'll talk about why that is. And annual change in debt, again, the company's piling on debt every year, which would normally be a red flag, but it's not in this case. And we'll go over all of those as we look at the rest of the charts. So as always, we look at gross margins first. You can see here that the green line represents the desirable gross margins, and Apple is always very close to that number, within a few percentage points, not enough to squabble at, especially now when you see the rest of the stats we're going to look at in terms of this company. This shares earnings, and this slide is earnings and earnings per share. You can see that the first slide, which is gross earnings, which is earnings, profits, you can see that it's gone up parabolic. It continues to go up. Obviously, it went up down a little bit between 2015 and now, but that's sort of a natural hiccup, I think. Again, looking at this company, this is why I don't mind so much the gross margins, because they're able to increase their profits so much. And when you look at, again, the profits on the next slide, which is earnings per share, you can see that they go up even more parabolic, even more dramatically than just straight earnings do. And that's because the company's been doing a great job of buying back shares in addition to making more money every year. Next thing we look at is net earnings as a percentage of revenue. You can see here that Apple has always been in the top 25. It's always also above my goal line. I have a line here which I like to see companies above if you're going to be interested in them, and it's been above that line since about 2010. So this company, in terms of its ability to take money from the gross revenue and put it on the bottom line, does a fantastic job, which means that the company probably has very real pricing power for its products. So the next two are selling and general administrative and plants and equipment. Selling and general administrative done a fantastic job of keeping this low. You can see that it was actually pretty high in 2001. It was a very bad company in that category, and it went down every year. And now since 2011, it's been in the top 10% of companies in terms of selling and general administrative. It's really more in the middle of the pack in terms of plants and equipment. But again, I'm okay with that. There's going to be some companies that are not going to be 10% in every category. You can see that it's consistent. It's in the reasonable level. It's not something you write home about, but it's also not something that scares me about the company. So inventory and R&D. You can see here that inventory for the company is not zero. In order to be in the top 30% of companies, you need to have zero R&D, but zero inventory. But again, in order to do that, you can't be a company that sells products. You have to be a company that's selling services or software. So for a products related company, I think Apple is on the right end of the curve. It's not a number that scares me. R&D is a number that concerns me. R&D, Apple is in the bottom 25% of companies. Now, remember that, call it 50% of companies do no R&D. So Apple is, by definition, when they start doing R&D, in the wrong end of the pool. More important than the amount they spend on R&D is the fact that they are constantly having to spend this money to stay ahead of their competition. If you remember, there was a company called BlackBerry. They didn't spend enough money on R&D. That company doesn't exist because it got destroyed by Android and by Apple. And so not only does Apple spend all this money in R&D, but they probably will have to spend that money, infinitely going into the future. They're trying to offset some of that with Apple Pay and with iTunes and hoping to get money off of their existing infrastructure. But that infrastructure will dry up pretty quickly if and when they don't have the coolest products. So I assume that the R&D number for Apple will always be very high, but it's kind of interesting that if you think that most companies can't compete at this level of R&D. If you're somebody out there trying to create a new phone, how do you compete with the budget that Apple is going to throw at trying to compete with you? So it's almost the fact that they're spending this much R&D will insulate them from people who create a better mousetrap. This chart is looking at debt, and so the green line is total debt. You can see that number is over $225 billion. That's made up of two components: total current liabilities and total long-term debt. I'm not bothered with the total current liabilities. That line is going up slower than profits, which mean that they're doing a reasonably good job of running the business, and there's always going to be some current liabilities when you have a going concern. The one that would cause concern if I didn't know what I know about Apple is the total debt. Why is a company that's making $60 billion a year needing to borrow so much money? So the logic here with Apple is they are producing a tremendous amount of money overseas. and they can keep that money overseas and not bring it back to America and avoid paying taxes. The problem with that is they now have a whole bunch of cash overseas that they can't get access to. And so what they do instead is they borrow money, knowing that they have more than enough money to pay that back in overseas investments. That allows them to do things like buy back stock and pay dividends and run operations without having to bring back that money from overseas and pay a bunch of taxes. Now, you may be opposed to the idea that they're not paying taxes that you think they should as a citizen, but I don't look at a corporation's goal as paying taxes. I look at a corporation's goal as creating wealth for me, the investor. And to that extent, I think Apple's doing a very good job. And so that's why I'm not concerned at all about the fact that they've taken on, $125 billion of debt. But I mean, just think about the scale of that for a minute. $125 billion of debt, and it's not even a concern. That's how big this company is. So I talked earlier about interest expense. You can see in the first slide that the interest expense has gone from nothing in 2012 up to $4 billion a year. Again, a massive number. And you see $4 billion a year in debt, and you think, well, that's atrocious, that's horrible. But then you look at the next line, which is interest expense as a percentage of operating income. My goal is that they won't spend more than 15% of their operating income on interest expense, and they're nowhere near that. They're at 4%. So the fact is that the interest expense is irrelevant in terms of operations. It's irrelevant in terms of while the number is big, in the scope of the company is not very big at all. And you're going to see in the next slide an even more interesting reason why I have no concerns about interest at all. Here we see an analysis of net interest expense. So what I've done is I've looked at two different things. What is the interest expense for the company? That's the blue line. You can see that it's going up. The next one is interest income. Apple has taken its money that it has in foreign countries that it doesn't want to bring back, and they have invested that in long-term investments. The result of that is that it's throwing off almost $6 billion a year in interest income. So they're getting $6 billion a year in interest income. They're paying $3.5 billion in interest expense. That's a net of about $2.8 billion a year in investment income. So they're making more money off the money they have invested than they're making off the money they've borrowed, almost 2 to 1. And that lets you gives you a real sense of calm that the interest expense for this company is completely irrelevant in the scheme of things. It's interesting that when you look at Apple's current assets to current liabilities, you can see their current assets are about $140 billion. You can see that that's only barely more than the $105 billion in current liabilities. Again, that's not a big deal. They have this nest egg, if you will, of $170 billion elsewhere in investments, but they're really doing a very good job, if you look at this graph, of making sure they have enough money to cover their current liabilities, but not much more than that. They're being efficient with the use of those funds, and as a stockholder, we should appreciate that. If you read the press about Apple, you'll see them say things like, Apple has $225 or $240 billion in cash and marketable securities. The fact is that's not true. It's misleading. Apple technically has something like $90 billion. I mean, what's $100 billion between friends? But they have $90 billion in cash and marketable securities. They do not have $225 billion, as the press likes to report. What they do have is investment and advances to the tune of roughly, I guess it's about $170 billion. So they have $90 billion in cash, and they have about $170 billion in investments and advances, and that's that money that we've talked about that's overseas. But when it's called investments and advances, that is not cash and marketable securities. Cash and marketable securities are cash they could lay their hands on within 12 months. And these investments is cash that they typically would take longer than 12 months to get their money back. Probably it's a distinction without a difference, but it's important to point out that the press that are reporting this big number for Apple don't really understand what's happening. They're simplifying it for the layman. That's not good enough for us. I really want you to understand what's happening with the company. But again, the amazing thing is that Apple has, again, about $240 billion in assets that it could, in theory, get its hands on to pay or to invest or to use to pay off debt, for example. The next two slides are dividends and dividends per share. And this is one of two areas where we should thank Carl Icahn. Apple didn't pay a dividend up until 2012, which really was sort of egregious. The company's making a tremendous amount of money, and it wasn't doing a very good job of returning money to shareholders. It was just sitting on all that money. And Carl Icahn came in and bought a bunch of Apple stock and did what he did, which is to rabble-rouse. And he sort of shamed the board into starting to pay dividends. So they started to pay dividends in 2012, and then those dividends have gone up dramatically every year. The dividends per share have gone up an even faster rate, and that's because they've bought back shares, as you're going to see later. We're going to talk a lot about dividends in the next few slides. As we do with most of these stocks, if they pay any dividend at all, we look at the company's dividends in four factors. We look at the yield and the growth of the stocks, the growth of the dividend. We look at the dividend safety in the context of earnings, the dividend safety in the context of cash flow, and the dividend safety in the context of its current debt load. In terms of yield and growth, the company pays a 1.55% dividend yield. The S&P 500 average is 1.92, so it's slightly below average for the S&P 500. That's disappointing. You'd like to see that number higher. However, as I'm going to show in later slides, they do a great job of buying back stock, which offsets some of this to some degree. The average dividend growth is 10.7%. We like that a lot. Anytime your dividend growth is outpacing inflation, that's a good sign. That means if you're in theory living on the dividend income, you get a raise every year relative to inflation. So I like that number. All in all, I'm not upset with this number for Apple. I know that they do a good job with the money that they do hold. Dividend safety in the context of earnings. The current payout ratio is 26.4%. That means that of their profits, they're paying about 26.4% in dividends. That's not tremendously high. It's not high relative to the S&P 500. Leaves them tremendous margins to do other things with their money if they need to. The average payout ratio for the last 5 years was 28.5%. So again, they're sort of right in the range that they've always have been. There's no reason to doubt that the companies will have an ongoing ability to pay its dividends based on the fact that they're paying such a relatively low current payout ratio. Again, I would like to see them pay out even larger number than this, but because they're buying back stock instead, I'm really okay with that. Dividend safety in the context of cash flow. So let's talk about this at length. The dividend payout of free cash flow is about 24.7%, and the average payout ratio for the last 5 years is about 22%. I'm going to take the last year and sort of walk you through these numbers because I don't know that I've done that in previous slides. So the cash flow from operations in last year was $64 billion. They had capital expenditures, that's money with the cash flow from operating expenses. The cash flow means that there's actually cash coming into the bank. That's not money that's been loaned to them. That's not debt. That's actual cash that came in from operations, $64 billion. They spent $12 billion of that on capital expenditures. Again, that's money that went out. That leaves free cash flow of $51 billion. So there's $51 billion of new cash in the company throughout the course of the year that they have to use as they see fit. They use $12 billion of that to pay dividends, which is 24%. Really a relatively small number, a number that's completely sustainable. So there are no reason to doubt the company's ongoing ability to pay that dividend based on the context of cash flow. Dividend safety in the context of its current debt load. Normally, a company has $140 billion in debt. This would be something I would spend a lot of time on. However, I think it's fair to say that we've already demonstrated that they have investment income which generates $6 billion a year in income, and they have a debt load which causes $3 billion a year of interest. So their interest is more than covered by their investment income. As a result, I just don't think that the debt is in any way significant relative to the company's ability to continue to pay its dividends going forward. So I'm just not even going to bother with a full analysis. That number alone is giving me enough comfort. Here you can see a slide which talks about the amount of shares that are outstanding. You can see that they have bought back a tremendous number of shares since, I guess it's 2011 or 2012. Again, Carl Icahn got involved and made them start doing this. And you can see that the company is down, they've bought back something like 20% of their shares in the last 5 years. That's a trend they claim they're going to continue to do. And you can see in the next slide that the number above zero is the shares that they're buying back. So, they're buying back, call it 300 million shares a year. That's an amazing amount of number, especially when you consider stocks are currently trading at $200 a share. This company is just doing a fantastic job between paying dividends and buying back stock, of returning wealth to us shareholders. Shareholder equity, this is something that you need a minute to think about and you have to work through so you understand it. Normally you'd see this slide in a good company, the graph goes, up and to the right. And this one, it stops at about 2011 and it stops going up. And the reason it stops going up, we've actually already talked about, but you probably haven't thought about. It's hard to build equity when you're paying back so much money to the shareholders. So rather than continuing to build equity, they're paying the shareholders dividends and they're paying the shareholders money by repaying, by purchasing shares. So when you purchase shares, that's less cash you have and you don't really have a new asset. You just, the existing shareholders own a larger portion of the company. So the shareholders' equity will decrease. Now, if I looked at shareholders' equity per share, you would see it continuing to go up because they bought so many shares. But we're looking in terms of total shareholders' equity. And so I want you to understand that when we're spending all that money to buy back shares, we're actually reducing the equity, which actually is fine because that makes it easier for us to earn a return on equity and return on investment. Here you can see Apple's return on assets. And again, the red line represents companies in the top 10% of the 800 companies that we've looked at. And you can see that Apple's just always in the top 10 year after year after year since 2005. They peaked in 2012, and I suppose you could get really mad that it's gone down significantly since then. But I mean, the fact is, sooner or later, the iPhone was going to stop being so new, and they're going to start making incremental improvements, which is what's happening now. But even so, between 2017 and 2018, the return on investment went up. This is a fantastic chart. There is absolutely nothing to complain about with this chart. This chart alone would make you think about buying this company, even if you didn't know everything else there is to know about it. Just as in the last slide, the red line represents being in the top 10%, and this is return on shareholders' equity. You can see that they've been in the top 10% of companies with return on shareholders' equity since 2010. That number has actually really started to accelerate, and the reason that it's accelerated is because it's earned slightly higher profits every year, and they've done it on lower and lower total shareholders' equity. And so that really does create a great return. I mean, they're up over 45% return on shareholders' equity, over 50% return on shareholders' equity last year. That's unheard of. That's spectacular. And for a company that's got almost $1 trillion in market share to be doing these kinds of numbers, it's really hard to fathom. It's just unbelievably good. The first question that I like to ask about a company in summation is, does the company have a consumer monopoly? Would consumers pay more for the product branded with an Apple logo than some other generic electronic company's logo? I think the answer here is an unqualified yes. I'm one of those people. I think I'm relatively conservative and relatively frugal, but I constantly find myself paying out more money for Apple products than other products that I could buy. The laptop that I just bought, for example, I could buy for a fraction from a PC. I could buy a PC for a fraction of what I paid for the Apple laptop, and there I was buying the Apple laptop. I just did a count. I currently own and use one Apple laptop, one Apple Watch, which I plan on upgrading. I own Apple AirPods, which I just replaced. I have an iPhone. I have an iPad, which I plan on upgrading. I have two Apple TVs, an Apple Pencil. I have various charging cables. I have an Apple HomePod, which I plan on buying more of. I use Apple Music for $10 a month, iCloud storage for another $10 a month. I buy Apple books every week or two from Apple for, call it $20 a book. I buy movies and games 2 or 3 times a month. It just goes on and on and on and on. This company makes fantastic products. They've got an ecosystem which once you're in the ecosystem, you're going to stay there. So once they have a customer, not only it's almost like an addictive product. You almost have to continue using it. So the next question is the company solid financially? Well, it has $240 billion in cash and long-term assets. That's pretty significant. It earns $60 billion a year in income, and it only has $115 billion in debt. I mean, listen to the numbers I just described. I just said this company only has $115 billion in debt, like it's nothing. Most companies in the S&P 500 aren't worth $115 billion, let alone have that much in debt. But look at it this way. Its long-term investments pay $6 billion a year. Its debt service is about $3 billion a year. So if you look at just the income it derives from its long-term investments, and you subtract out the cost of its interest expense, that's $3 billion a year in profit. That $3 billion in profit alone would make Apple the 73rd most profitable company in America. And more interestingly, the company that it was number 4 is Amazon. So Apple makes more money off its long-term investments than Apple makes off of all of those deliveries that it does to every house in America day in and day out. Does the company reward its owners? So yes, it does. First of all, it generates fantastic profits, great returns on assets, great returns on equity. It pays a market average decent dividend. I'd like to see it pay more, but you can't complain if it's market average. That dividend is increasing at about 10% a year on average for the last 5 years, so that's solid. More importantly, the company has repurchased 1,528,000,000 shares of stock. That's not $1,528,000,000 worth of stock. That's actual shares of stock. So to put that in perspective, the market value of those shares today is over $280 billion. So in the last 5 years, Apple has bought back, maybe it's 6 years, Apple has bought back $280 billion worth of stock. That's wealth, it's returned to the shareholders. And so the answer is, of course, Apple does a great job of rewarding its owners. So would I buy this stock? At its current price level of $189.16, I would absolutely recommend this company. My final slide every week is to look at our previous picks. We've suggested that you should buy Altria Group, T. Rowe Price, Argan, Martin Transport, and now Apple Computer. Basically one a week since the first week of February. So really it's been, call it 7 weeks since we started doing this. The best stock we have, Altria, is up almost 15%. The worst stock we have, Martin, down almost 7.5%. In total, we're up about $1,000, so our picks are up and they're up more than the market. But it's really, really too early to grade us. We've been doing it for a couple of months. Good things are going to happen, bad things are going to happen in that shorter period of time. It's too soon for me to take credit for the wins and too soon for me to be blamed for the losses. Again, we just want to chart these. I'm looking at all of these as very long-term picks, but in the short term, we're doing okay.